Let's move over to options. So options slightly different. In the future, beforehand, we have the obligation of both sides. One side had to deliver the cattle, the other side had to deliver the money. Nobody had a choice. They both had to stick to the contract. With an option, it's different. It's just like the word saying, option means you can choose something. So if you buy an option, if you're the option holder, you have a right. You have a right to exercise the option, so you have a right to use that piece of paper, the contract, or you have the right to just throw the contract in the corner and say, no, I'm not interested in it anymore. And that's a big difference with the future contract. So with the future contract, both sides have to stick to it all the time. With the option contract, one side has a choice. We've got two different options. We've got a so-called call option and a put option. And you can also buy a call option, or you can issue a call option. So there's going to be lots of different sides. So there's basically long is buying, short is selling. So we've got long and short, and we've got call and put. And we've got all combinations of the two. So it's very easy to start mixing things up. That's the reason why I thought I'd give you a little bit of a way to, well, I don't like memorizing, but to be a bit quicker of which is what. So call option means you want to buy something, you want to get the stuff. If you have a call option that gives you the right to buy something at a fixed price, the fixed price here is called exercise price. So a call option is the right to buy. And I memorize that this way. If I'm calling my dog, for example, I want him to come to me. If I'm calling oil, I want the oil to come to me. So I want to have the right to buy oil. If I'm calling US dollars, I want US dollars to come to me. Right? So it's buying stuff. As opposed to put option. In a put option, you have the right to sell stuff, to get rid of something. Like putting your bags down, put something away. So you want to get rid of stuff. That's a put option. Good, so we've got the writer and the holder. So the holder here has the right, and the writer has the obligation. So the writer is on the other side. He has to deliver, and the writer cannot choose. So if you have a contract with the writer, you're the holder, and you can choose if you want to stick to the contract or not. But the writer on the other side cannot choose. As soon as you say, I want to have my stuff, I want to buy that thing now off you at that exercise price, the writer has to deliver. Or if you have a put option and you call the writer and say, listen, we have that contract here, I want to now sell it to you at the exercise price, the writer has to stick to it. He can't choose. So there you can see already which position is riskier, holder or writer. Writer is way riskier. That means that all of us can actually buy options, so we can all become holders of options. And that's quite exciting too, because there's a lot of leverage, lots of volatility in there. On average, I should tell you, you lose money if you do that, but it's exciting. But the writer of the option, that's a very dangerous business. Only wealthy individuals and institutions can do that. Usually only institutions are the writers of the options, large banks. Good, so what kind of risk do we have here? So let's play through these graphs. So we've got the long call option here. So first we have to translate it into normal words. Call option means we have the right to get something. So like calling the dog, we have the right to buy something. And because we go long, we are buying the right to buy something. So now we are looking at the holder's position. Somebody bought the right to buy something. In this case here, somebody bought the right to buy Apple stock. The strike price is 610, so it's the right to buy Apple stock at 610, and somewhere it should tell us the time too. It doesn't here, so we're just making something up. Let's say in 1 year's time. So in 1 year's time, you can buy Apple shares at 610. We have the right to buy them at 610. And then we've got something else here. We've got the option price. So we don't get that right for free. We have to pay something for it. And the current market price for that one is $10. So we pay $10 for a piece of paper that allows us to buy in 1 year's time Apple shares at $610. But we don't have to buy these Apple shares. If we don't want it anymore, we can just throw the contract away. There's no obligation for us. We have the choice. And let's see what happens here. So if the share price in 1 year is $600, $500, if the share price is basically dropping now, what would you do? Would you use your option? Would you exercise your option and call the other side and say, listen, I want to buy Apple shares now at 610? Or would you throw the contract away? throw the contract away. How much money have you lost then? $10. That's exactly right. It's so-called out of the money. So if the actual share price, spot price, is falling below the exercise price, the option is worth nothing. You just throw it away and you've lost the price that you paid for the option initially. But now if the price starts rising, let's say we had $605 for the Apple share price next year. Would you use that contract or would you throw it away? So let's do the math here. If you use the option, you can buy the share at 610, which is $5 cheaper than 615. And what could you immediately do if you want to make a profit? Sell them. So you buy them with the use of the option that you already have at 610 and immediately sell them in the market at 615. You make $5 profit. But it says here in the graph you make a loss. How come? I just thought you make $5 profit. You buy at 610, you sell at 615, but of course, in the beginning of the year, you forked out $10 to get the contract first place. So you forked out $10, you make $5 profit here. If you net that out, you basically still are $5 in the minus. And then we can say with the break-even point, so once the share price is going $10 above the exercise price, you're breaking even, and now you're really starting making profits here. Here, the call option just from beforehand, in the money, at the money, out of the money. So it's easiest in the graph. So basically the important thing here is the exercise price. As soon as you're going over the exercise price, now the option is getting interesting and you're using the option, and that's called in the money because it has an advantage now to use the option. Even if you're going only to 611, you get your shares now at 610, which is $1 cheaper than in the market. So it already pays off to use the option. So that means the option is in the money. It doesn't mean that you make an altogether profit because you forked out so much money. So you're still here, but it's better than losing all $10. So it's 611. In the net, you made only -9, and so on, so on, so on, so on. But if the actual share price is under the strike price, then you're so-called out of the money. You're just throwing the option away. The call option, of course, when we talk about a put option in a second, everything flips around. So the call option is not worth anything as soon as the share price is under, or as long as the share price stays under the exercise price. Good, so your turn. So before you really dig into these things, some people of you might follow the share prices and might think like, what the heck are these numbers? Because I looked up the share price just recently, and we can see the share price of Apple is nowhere near $610. And also, if you look in the history, it doesn't look as if it was anywhere near $600 ever. And you can wonder why the heck is a book and Axel using these ridiculous numbers. And that is linked up with something that we talked about in the past. Remember when we have rights issue, if you issue additional shares, what's happening to the share price? You have more shares, the cake is getting a bit bigger too, but usually the new share price is going to be, you cut the larger cake in lots and lots of slices, so each slice is going to be smaller. So usually after rights issue, share price issue, the share price is dropping, but therefore you've got more shares around. And also what companies sometimes do is the share price is going too high. So we had, I think Allianz in Germany had a share price of 10,000 D-Mark per share, which is like over 5,000 euros. Now it looks good for the people that bought the shares in the past cheap. But imagine if you want to liquidate 2,000 euros and one share is already worth 5,000 euros. What's your problem? Can you sell half shares? No, right? So if the share price is going too high, the shares become very illiquid, and that's a disadvantage. And then what companies are doing is simply a so-called split, a share split. So they're basically saying, okay, everybody that has one share is getting 2 shares now. You don't have to give us any money. We're just splitting your one share in half, and you get 2 shares. And what's immediately happening to the share price then? Let's say, for example, if I make a 1-for-2 split here, yesterday one share was worth 610. If everybody's getting 2 shares, each share will be worth 310. 5. And I've got twice as many shares, each worth half as much, so nothing changed, apart from the share price much lower now. So this is what happened with Apple. So Apple did several splits over the last few years, and if you're interested, you can look up the history here. They split up their shares frequently, and that's the reason why the share price is much lower than in the textbook at 2013. But I didn't want to change all the numbers, so we just use these numbers here. And this is your job now. Just go through them step by step. Hopefully you can manage straight away, otherwise I'll help you a little bit. So let's move on. Basically, these are two investment options. The question is, with your $600, you can either go fully into shares or fully into options. I didn't mean that you buy both of them. You wouldn't have money left over either to buy both of them, because if you buy one share, all your money is gone already. So you start off with $610. How many Apple shares can we buy? Well, since they cost $610, we can buy exactly one share. If the share price goes up to $630, from $610 to $630, we made $20 profits. Not bad. If it goes down to $600, well, then we made a $10 loss if we sell it. But what could we do a little bit more now than was in the question? So if the share price went down to 600, you paid 610. Do you sell your shares or do you do potentially something else? Okay, you can simply keep it. Hope that the share price goes up again in the future. Nobody knows, but maybe. Good, so here it's either 20 plus, 10 minus, possibly even keeping it. Now if you buy the call option initially costs $10. With 610, that means we can buy 61 call options. So you can see we can buy much more options than we can buy shares, because the option is only a fraction of the price of a share. So we can automatically always buy more options than shares. Step 1. Step 2, if the share price is increasing to 630, so that's basically, let's look at this one here. So if the share price is going up to 630, it's basically a piece of paper that tells us we have the right to buy shares at 610. So I can use that right now to buy shares at 610, immediately sell them at 630, make a $20 profit. And somebody correctly said here in class, well, we don't have $610 spare. We spend all our money on the option. But that's not important, because somebody else might be interested in that piece of paper. We can sell the option itself. We don't have to exercise it. We can just sell it to somebody else. And how much would anybody else in the market pay for the right to buy shares at 610 if they are priced in the market at 630? $20. And we've got 61 pieces of paper. Each piece of paper used to be worth $10, or we bought it at $10. Now they're $20, so we doubled our money. We have now $1,220 worth in options, which we can sell. Since we invested $610 initially, we make $610 profit. So we doubled our money. That's the good side. So that's much more exciting than just having $20 plus in the share. The share price, the same thing, went up from 610 to 630. But if we go via the options, we doubled our money. If you bought the share, we just made $20 plus. Huge difference. But the difference is on the downside too. Now if the share price is dropping by the exercise date to 600, how much is that piece of paper worth that allows you to buy shares at 610? Nothing. So you throw it in the bin, or nobody else for sure wants to buy it from you either. Nobody wants to have the right to buy shares at 610 if they can buy the shares in the market at 600. That would be a useless right. So it's worth nothing, and you've lost all your money. You lost all $610. And another difference is, can you just wait and hope that these options become more worth in the future? No, because you have the exercise date written on it. As soon as the exercise date is there, that's it. You either exercise the option on that date, or it's all done. You don't have the right to exercise the option 1 or 2 days later. There's a fixed endpoint in the option. Good, so what we learn out of this one here is options are way riskier, at least if you use it for speculation. If you would have used the option because it's a call option, because you know that in November 2013 you have to buy Apple shares for whatever reason. You promise in the book there at the example you get a big payout on that date, and you already know that you want to for sure buy Apple shares and you want to fix a certain price for it, so that in case the Apple share price is going up, that you don't have to pay too much. then an option would be a hedge here. But if you just buy the option by itself, it's pure speculation. And very exciting. So I made up these numbers. You might think it's very volatile and unrealistic numbers. But when I was young and didn't hear too much about the efficient market hypothesis, I did the same on US dollars. So US dollar call options, and they went my way, and I doubled my money too in no time. And because I was so great at forecasting the future, immediately I put all that money into Hang Seng call options as well, that the Hang Seng index will gain in the next 2 weeks, and unfortunately it didn't. Lost all the money straight away again too. So you have to be careful. On average, you usually don't make a profit on these options. That was the long side, so the buy. Now we're going over to the short side, the seller of the option. And now there's a big difference. As the seller of the options, there's an obligation. The seller cannot choose. Or the seller or writer is the same thing. They can't choose. If they sell a call option, that means they have to deliver the underlying asset on time at the certain price. If they're short on a put option, that means that they have to buy the thing on time. So they're basically the flip side of the other side. The other side gets the right, and the seller is losing their right. They have an obligation. And therefore, there's a chance of very high losses. So the maximum we can lose when we are buying options, the money that we have invested. The price of the option, that's the maximum that you can lose. So you can lose everything that you have invested. As a seller of the option, you can lose even more, because you're forced to, for example, deliver shares at a certain price. Doesn't matter how expensive they are in the market. And that's the reason why they put in regulation. Just imagine, for example, you promised to deliver shares at the exercise price. Now, if you have the shares already in your portfolio and the share price in the market is, so basically you're short, you're selling a call option to somebody else. So somebody else gets the right to buy the shares off you. If the share price is going up, will the other side, the buyer of the call, use the call or throw it away? Same example is here. Let's do it with Apple. Apple call option. If the share price is going up, the option is going to be used, exercised, or thrown away. Exercised. So that basically means that you as a seller, now the other side comes and says, listen, I've got the right to buy the shares off you at the exercise price at 610. You have to deliver them now. So if you've got the pile of Apple shares lying there, you just have to give them over at $610. Well, you lose your shares instead of potentially selling them in the market at a higher price. So it's a bit of pain, but it's not too bad. But now imagine if you don't have shares there. And that's the so-called naked short sell. So if you've written an obligation to deliver Apple shares, but you actually don't have any Apple shares there. And now the Apple share price is not going to $630, but to $1,000, $2,000, $3,000. You have a contract that says you have to deliver them at $610. Can you see what happens to your losses? Well, let's say the share price is $1,000. You have to deliver them at $610. How much loss do you make on each option? $390 minus for you, because you have to buy now the shares at $1,000 to deliver that to the other person at $610. And there's no upper limit for your losses, because if the share price going to $10,000, you make even more losses. So these are kind of unlimited, very, very risky. And that's the reason why the regulator said no more naked short selling. So in the past we were allowed to do it, but since the financial crisis, no more naked short selling means you have to have shares lying around if you want to short sell them. So as a seller of a short sell, you hope, of course, that the other side is throwing the piece of paper, the option, in the bin. So then you don't have to deliver, and you just pocket the money. The short side is the exact flip side. So remember beforehand, the one that is buying the option has to pay $10 premium. Now that you're selling the option or writing the option, you get the premium from the buyer, of course. So you get $10. And in this case, it's a call option. So the other side is using the call option only if the share price is much higher. Remember, we're talking basically about this option here. We're just looking now at the sell side, not the buy side. Right? So this guy is using it only if the share price is going over 610. That means as long as the share price is going under 610, the other side is not using the right They're not giving you a call and they're not saying, listen, I want to have these shares. They're just throwing the option in the bin, and that means you don't have to do anything. You don't have to deliver shares, you don't have to pay anything, nothing. You just pocket the $10 that you've earned when you've written these options. So that's good. But as soon as the option starts to get into the money, now the other side is giving you literally the call and says, listen, I want to have the shares at 610 and you have to deliver them to me. And so now on paper at least, I start making losses because I have to give up these shares at 610, even though the market price might be, for example, 620. So I'm missing out on $10 profits I could have made in the market because I have to hand away my shares at 610, but at least I got the $10 premium, so it's plus minus 0 at 620. But if the share price is going even higher, let's say to 630, I could have sold my shares in the market at 630, but I have to sell them now at 610 because my name is on the option contract that I'm going to deliver my call, and the other side is calling me now. And even though I initially earned $10, because now I'm missing out on $20 profit, I'm getting $10 into the minus here. So that's the risk here. And you can see here, infinite. So the higher the share price goes, the higher my potential losses are, or missed out profits at least, opportunity costs, you might say. And again, I want to translate. Short means I sold these things, and call is the right to buy. So I've given up my right to buy to somebody else. And that translates to I'm obliged to sell it to the other person. Because the other person has the right to buy. Means I've got the obligation to sell. Long put. Translating it, long means buy. Put is the right now to get rid of something, so the right to sell. At the exercise price, strike price here. So the right to sell at $590. If the share price is over $590, is anybody using their right to sell at $590? If you can sell at the market at 600, would you prefer to use your right and say, no, I'm going to sell it at $590? No. Right? Nobody's using it. That means the option is going in the bin. You're not exercising it. And since you're long, you paid for the option initially, the premium. That means you just lose the money that you initially invested. That's the reason here your losses are limited to whatever money you invested. But now the flip side, if the share price starts dropping, let's say, for example, 540, and you've got the right to sell the shares at 590, would you use that right? Yes. How much is each right worth? So basically, if you have that right, you can buy the shares at 540 in the market, immediately sell them to the other guy at 590. So per share, you would make a $50 profit. And your net profit is basically the $50 profit here. That's the worth of the option, minus whatever you paid for the option initially. Right? So that is explaining this one. Of course, that put option is getting more and more worth the lower the share price drops here. Then we've got the flip side of that one. So somebody short means selling, put options. So they sold the right to sell shares to somebody else, meaning now these guys have the obligation to buy the shares at 590. So that's the exact flip side of that one. You can see even in the graph it looks like the exact flip side. So here they're paying the premium, these guys are getting the premium. Here these guys are happy when the share price is falling, these guys are unhappy when the share price is falling. It's the exact mirror image. If the share price is very high, nobody is going to exercise the put option. Right? That's what we had here. If the share price is very high, the people that have that piece of paper to sell, the right to sell at 590, nobody's using it. That means the guy that has the obligation basically doesn't get a call at all. Nobody's interested in that piece of paper anymore. He just pockets the $5 that he initially sold these pieces of paper for, and that's it. But if the share price is starting to drop, now he's getting a call from the other side saying, listen, you promised to buy the shares at 590s from me, and since the actual share price is much lower, he's making more and more of a loss because he has to buy the shares 590, even though they're worth only 585, 550, 400. So this guy is making more and more of a loss here. As long as the share price just dropped by $5 in our example, he's still breaking even because he had $5 from the beginning. He's making a $5 loss on the share transaction itself. Break even.